In this module, we are going to be discussing the topic of accounts, payables, and then liabilities in general. So first of all, what are liabilities? When you hear that phrase, when you hear that term, you think of having to owe somebody, which is exactly what it is. Something has happened that's caused you to owe some other party. The gap definition for liabilities, it hits on a few important points. It states that probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. So there's quite a bit going on with that definition. One key word we want to point out is the very first one, probable. It's not a guarantee. There are some liabilities that are not 100% for sure at this point. So it's probable. It's more likely than not that we're going to owe something in the future. That's the other thing. This is a sacrifice that's going to take place in the future. If we've already taken care of it, if we've already paid it, it's no longer a liability. It's been paid. The sacrifice of economic benefits is basically talking about giving up cash. That's the most common item you're going to be sacrificing. It's a present obligation, which means today you know you owe it. You have this debt today. And it's a result of past transactions or events. So something has happened in the past that's caused us to owe this money. So let's move on and talk about short-term versus long-term liabilities. When you hear short-term, this is sometimes referred to as current. What it means is it's owed within a year. For this module, we're going to be going with just the normal 1-year breaking point. So a short-term debt is owed within 1 year. Long-term or non-current is owed in more than a year. Now there is something known as a current maturity of long-term debt. And this is basically it's an actual long-term debt. So it's the total amount is owed in more than 1 year. But every portion, if it's an installment type note, there's a portion due this year. That portion is carved off and treated as current. It's a current maturity of long-term debt. So on the financial statements, you will see it in the current liability section versus the long-term liability section. The next distinction we need to make is between accounts payables and notes payables. The accounts payable is the focus for this chapter, and what we'll see with the accounts payables is generally less formal. So there's not really a signed written agreement. There's no promissory note involved. A lot of times this is a relationship between a store and between two different stores, a vendor and a store or some other company. Generally, there's no interest involved, and the reason for this is that it's such a short period of time, and that leads us to the third bullet point. It is indeed a shorter period of time. For notes payables, these are generally more formal, like a promissory note. They tend to have interest because they're a little bit longer period of time. So on the financial statements, you'll see this in the section entitled Liabilities. So you'll see the accounts payable there. You see a variety of other payables. Now, what we're going to really focus on for this module is accounts payables arising from inventory purchases. Now, there are other accounts payables. You could just buy supplies and you'd have an accounts payable. But generally for accounting courses, when you hear accounts payable, it generally relates to an inventory purchase. So that's what we're going to focus in on here. Now, what we have down at the bottom is just a general example of a journal entry when we purchase inventory. So on 1/1/16, we debit the inventory account to increase it by the $100,000, and we're crediting the accounts payable to increase that liability by the same amount. So pretty straightforward journal entry there. Now we're going to move on to the topic of purchase discounts, and we're going to see some example journal entries here as well. A purchase discount is when you receive a reduction in the price due to early payment. Now, on day one, when you make the purchase, it's not known whether the discount will be taken. It won't be known until we know what the payment date is going to be. Now, an example of a pretty standard discount term or credit term is 2-10 net 30. The N stands for net. This tells you that there's a 2% discount for any payments within 10 days. Otherwise, the net amount is due within the 30-day full credit period. So 2-10 net 30. Different companies have different credit periods, but that's the example. Now, for the actual journal entries, we have to talk about two specific methods that a company could use for recording these journal entries. They may use what's known as the gross method, or they could use the net method for recording discounts. These different methods basically tell us whether the company assumes they're going to take the discount or not. So the gross method essentially assumes the discounts will not be taken, and what it does is we report the inventory purchase at the full cost, the gross cost, before subtracting out a discount. Now, if later on we do end up taking a discount, we'll have to adjust the inventory cost down. The net method basically assumes the discounts will be taken, and we're going to record it at the discounted amount. But then if the company, for whatever reason, decides they are not going to be taking the discount, they fail to pay on time, then they would have to record this lost discount, so to speak, in a separate expense account. So let's take a look at how those journal entries look. Let's go ahead and record the purchase discount under the gross method at the purchase date. So on this date, we're going to be recording the full amount of cost for the inventory. So we will debit inventory for $100,000. We will credit accounts payable for $100,000. This reports the full amount, assuming we are not going to take the discount. Now, if the discount is not taken, which is what we assumed, the payment is simply going to be a debit to accounts payable for the full amount to reduce it, and a credit to cash to show the payment of cash, reducing the cash. Now, if it turns out we do take the discount, we have to debit accounts payable for the $100,000 still, because we have to get that out of the books. But the credit to cash is not going to be $100,000 because we're not paying $100,000. Instead, we're only paying $98,000. The additional $2,000 is going to be a credit to inventory to show the reduction of the inventory cost, to bring it down to the amount we actually did pay. Now, if we did decide to use the net method instead, we're going to be reporting this purchase on the purchase date at discounted cost. In other words, we're assuming we're going to take the discount. So we debit accounts payable for $98,000, which is the discounted amount, and we credit cash for $98,000, again the discounted amount. This assumes we will eventually take the discount. Now, let's assume now that the discount was not taken. We assumed it would be because we used the net method, but it wasn't used for whatever reason. It wasn't taken. So we will have to debit accounts payable for $98,000, the full amount, to reduce it, to get it off the books. We're going to credit cash for $100,000, which is the full amount we had to pay. Now, the $2,000 extra dollars here is a debit to discounts lost. Now, this account is essentially a miscellaneous expense account. It's for managers to track those discounts that were not taken. They assume they would, so they probably have a policy in place that says they should, but for whatever reason they didn't, so management wants to know about it. Now, under the net method, again, we assumed the discount was going to be taken, so let's look at the situation if it is indeed taken. We would debit accounts payable for $98,000, just to zero it out, and we would credit cash for $98,000 as well. This is at the payment date. So we've looked at the two different methods, with and without the discount. 2% doesn't seem like a big amount, but in reality you have to remember that this is not an annual rate. This is essentially a 20-day rate. We are getting that 2% discount for paying 20 days earlier than we otherwise would have. So when you annualize it, if you do the math here as shown below, this would actually be 36.73%. So that's why a lot of companies like to use this. They like to pay early if they can in any way. They save money. Now, from a seller's side, the reason the discount is a good thing is you're more likely to get your money quickly and you're less likely to have bad debt expense to worry about. And that concludes our discussion of short-term liabilities, accounts payables, and we will move on to the next module.